Hi, Matt McAleer, President, Director of Private Wealth, Cumberland Advisors, July 12th, just after the close this week. Extremes. We talk about extremes all the time. Most of the time, markets are trading within extremes. But when we get to those bell curve, those outsized pieces of the bell curve that we call extremes, we have to be careful about reversions to the mean. That's what we saw this week. Growth, specifically tech, took a breath off of some of the soft economic data, yields falling, and gave a nice spark to small cap, mid cap, value in general. When I say extremes, it was just earlier this week that equal weight S&P 500 was trailing cap-weighted S&P 500 by almost 15% year to date. That's an extreme. When we plot that for the last 30 years, it's extremely rare. When we look at small cap earlier this week, flat on the year, the Russell 2000, with the S&P up 17.5% midweek. That is an extreme. So it doesn't take too much to start to create a reversion to the mean. Now, all extremes revert. They don't necessarily revert all the way, but they do revert. And we saw a little bit of that this week. Probably in terms of a guessing game on my end, an exhale on large cap growth. In terms of will we continue to see a bid to the small and mid cap area? As long as yields can stay down, let's call the 10-year in a 375 to 450 range and not bounce back up to 4 3/4, 480. In that nice range, I think we'll continue to see breadth expand. We spoke about this the last few weeks, how narrow breadth was. Really had to be in specific names, not even sectors. In a great performing tech sector, it was even narrow. So it's really heartening to see breadth expand. We'll keep an eye on that next week. I think we'll get some nice opportunity to buy some of these pullbacks off this week's breakouts in small and mid cap. So we'll keep an eye on that. And if you can indulge me for a moment, I just want to send out a shout out to Dave D., a long-term client who is selling his company on Monday. Just as a quick note, at Cumberland, we have clients across all types of businesses, industries, sectors. One of the areas that I've worked with people for years, over 30 years, I have to admit that right now, is first generation self-made business people, women and men. And I'm proud of Dave selling his company Monday that he's been working from the ground up, put it together himself for 38 years, investing over the last 30 years, side by side, sharing advice. He would advise me, I would advise him, we would learn from each other, trying to take a reasonable approach to the markets. And it's been successful, and it's allowing him to sell his company, take some time off, enjoy life. And part of what I'm mentioning here is just that grind of staying in the market, looking for opportunity, not getting too high, not getting too low, having separate baskets of money. We call them buckets. Short-term trading money, longer-term growth money. Dave is one of the clients, fortunately, going back 17, 18 years ago, that we bought Apple. Dave owns it at $3.50, along with other clients. That is beautiful compounding over less than 20-year periods. So keep looking for outstanding companies that can compound your money. They're out there regardless of politics, regardless of cyclicality in the economy. Great companies get born in this country every year. So thank you for indulging me for that 2-minute rant. Now we're going to toss it over to John Mousseau, who's taping remotely this week.
Hi, it's John Mousseau. I'm the CEO of Cumberland Advisors. It is Friday afternoon on July 12th. This is the bond report. This week, good week in bonds. The 10-year bond sits here today at about a 420. 30-year bond is a 440. Go all the way back to the 2-year bond, which we know not too long ago was pushing 5%, is now down below 450. It's at about a 445, down about 15 basis points on the week. 10-year bond and 30-year bond are down about 9 basis points on the week. Why? Just good news on inflation. The CPI that came out this week, yesterday, was negative 0.1 for the month. That was a surprise when they were expecting plus 0.1. So the market is taking its cue from that. PPI number today was a little higher than expected, but the market shook that off. And the reason is that we've had a number of good months now with better news on inflation. And that's going to be important going forward. But when you look at it, you see the things that people can relate to out there. Energy down, cost to rent homes down, cars down. So it's starting to feel like inflation is moving in the right direction, finally, on a more sustained basis. And that, of course, gives the markets hope that the Fed will start to cut short-term interest rates, and probably as soon as September. Well, how many they do this year still open? September, we would think you will probably get a rate cut. And part of that, of course, is to get one out in front of the election and have it done so that, 2 months before the election, basically, they can say that they're not really being political in any ways. And then we will see what happens to the balance of the year. But it's been a long time coming, and we've talked a lot on these tapes about the anecdotal evidence that's out there, and you see it in these numbers that we just spoke today between cars and rents and energy, all things that people can relate to. And even in the PPI number, which is higher, some of those core items, which are numbers that feed into the PCE, the personal consumption expenditure that the Fed watches, they were also lower. Muni yields also lower this week across the board. 10-year AAA Muni's around a 280. 30-year Muni is around a 368 AAA. More importantly, deals that came this week got done. The Muni market has certainly been pricing higher as we've crept through July. We've talked about this. The big rollover period at the beginning of July has certainly had an effect. That money's been being spent. That has forced yields down somewhat. We expect some of this to be relaxed a little bit as we go forward, and supply picks up even in the face of some of that money already being spent from maturing bonds, called bonds, and coupon payments at the beginning. Next week, we will be watching basically the same stats, initial jobless claims. But the number that was really important this week was that CPI number. And more importantly, the 3-month and 6-month annualized rates on inflation have also come down. And that's the key to the Fed. So I think the fact that the Fed is now seeing 2 months in a row where numbers were lower than expected is very good news as we go forward. We hope everybody has a great weekend, and we'll talk to you next week.
Thank you, Moose. Everyone enjoy the weekend. We'll be back next week.